Bond valuation is the determination of the fair price of a bond. As with any security or capital investment, the theoretical fair value of a bond is the present value of the stream of cash flows it is expected to generate. Hence, the value of a bond is obtained by discounting the bond's expected cash flows to the present using an appropriate discount rate. In practice, this discount rate is often determined by reference to similar instruments, provided that such instruments exist. Various related yield measures are then calculated for the given price. If the bond includes embedded options, the valuation is more difficult and combines option pricing with discounting. Depending on the type of option, the option price as calculated is either added to or subtracted from the price of the straight portion. See further under bond option. This total is then the value of the bond. Bond valuation, as above, the fair price of a straight bond features, is usually determined by discounting its expected cash flows at the appropriate discount rate. The formula commonly applied is discussed initially. Although this present value relationship reflects the theoretical approach to determining the value of a bond, in practice its price is determined with reference to other, more liquid instruments. The two main approaches here, relative pricing and arbitrage-free pricing, are discussed next. Finally, where it is important to recognize that future interest rates are uncertain and that the discount rate is not adequately represented by a single fixed number, for example when an option is written on the bond in question, stochastic calculus may be employed. Where the market price of bond is less than its face value, the bond is selling at a discount. Conversely, if the market price of bond is greater than its face value, the bond is selling at a premium. For this and other relationships between price and yield, see below. Present value approach. Below is the formula for calculating a bond's price, which uses the basic present value formula for a given discount rate. Where F equals face values, if equals contractual interest rate, C equals F if equals coupon payment, N equals number of payments, I equals market interest rate, or required yield, or observed/appropriate yield to maturity, M equals value at maturity, usually equals face value, P equals market price of bond. Relative price approach. Under this approach an extension of the above the bond will be priced relative to a benchmark, usually a government security. See relative valuation. Here, the yield to maturity on the bond is determined based on the bond's credit rating relative to a government security with similar maturity or duration. See credit spread. The better the quality of the bond, the smaller the spread between its required return and the YTM of the benchmark. This required return is then used to discount the bond cash flows, replacing in the formula above, to obtain the price. Arbitrage-free pricing approach, C. Rational pricing, fixed income securities. As distinct from the two related approaches above, a bond may be thought of as a package of cash flows a coupon or face a with each cash flow viewed as a zero coupon instrument maturing on the date it will be received. Thus, rather than using a single discount rate, one should use multiple discount rates, discounting each cash flow at its own rate. Here, each cash flow is separately discounted at the same rate as a zero coupon bond corresponding to the coupon date, and of equivalent creditworthiness. Under this approach, the bond price should reflect its arbitrage-free price, as any deviation from this price will be exploited and the bond will then quickly reprice to its correct level. Here, we apply the rational pricing logic relating to assets with identical cash flows. In detail, the bond's coupon dates and coupon amounts are known with certainty. Therefore some multiple of zero coupon bonds, each corresponding to the bond's coupon dates, can be specified so as to produce identical cash flows to the bond. Thus the bond price today must be equal to the sum of each of its cash flows discounted at the discount rate implied by the value of the corresponding ZCB. Were this not the case, the arbitrator could finance his purchase of whichever of the bond or the sum of the various ZCBs was cheaper, by short-selling the other, and meeting his cash flow commitments using the coupons or maturing zeros as appropriate. Then her risk-free, arbitrage profit would be the difference between the two values. Stochastic calculus approach. When modeling a bond option, or other interest rate derivative, it is important to recognize that future interest rates are uncertain, and therefore, the discount rate, S, referred to above, under all three cases, that is whether for all coupons or for each individual coupon, is not adequately represented by a fixed number. In such cases, stochastic calculus is employed. The following is a partial differential equation in stochastic calculus which is satisfied by any zero-coupon bond. The solution to the PDE, given in, is: where is the expectation with respect to risk-neutral probabilities, and is a random variable representing the discount rate. See also martingale pricing. To actually determine the bond price, the analyst must choose the specific short-rate model to be employed. The approaches commonly used are, the CIR model, the Black-Derman-Toy model, the Hull-White model, the HJM framework, the Chen model. Note that depending on the model selected, a closed-form solution may not be available, and a lattice or simulation-based implementation of the model in question is then employed. See also Jamshidian's trick. Clean and dirty price. When the bond is not valued precisely on a coupon date, the calculated price, using the methods above, will incorporate accrued interest, that is any interest due to the owner of the bond since the previous coupon date. See day count convention. The price of a bond which includes this accrued interest is known as the dirty price. The clean price is the price excluding any interest that has accrued. Clean prices are generally more stable over time than dirty prices. This is because the dirty price will drop suddenly when the bond goes X interest, and the purchaser is no longer entitled to receive the next coupon payment. In many markets, it is market practice to quote bonds on a clean price basis. When a purchase is settled, the accrued interest is added to the quoted clean price to arrive at the actual amount to be paid. Yield and price relationships. Once the price or value has been calculated, various yields relating the price of the bond to its coupons can then be determined. Yield to maturity. The yield to maturity is the discount rate which returns the market price of a bond without embedded optionality. It is identical to in the above equation. YTM is thus the internal rate of return of an investment in the bond made at the observed price. Since YTM can be used to price a bond, bond prices are often quoted in terms of YTM. To achieve a return equal to a YTM, that is where it is the required return on the bond owner must buy the bond at price, hold the bond until maturity, and redeem the bond at par. Coupon yield. The coupon yield is simply the coupon payment as a percentage of the face value. Coupon yield is also called nominal yield. Current yield. The current yield is simply the coupon payment as a percentage of the bond price. Relationship. The concept of current yield is closely related to other bond concepts, including yield to maturity, and coupon yield. The relationship between yield to maturity and the coupon rate is as follows: when a bond sells at a discount, YTM current yield coupon yield. When a bond sells at a premium, coupon yield current yield YTM. When a bond sells at par, YTM equals current yield equals coupon yield. Price sensitivity. The sensitivity of a bond's market price to interest rate movements is measured by its duration, and, additionally, by its convexity. Duration is a linear measure of how the price of a bond changes in response to interest rate changes. It is approximately equal to the percentage change in price for a given change in yield, and may be thought of as the elasticity of the bond's price with respect to discount rates. For example, for small interest rate changes, the duration is the approximate percentage by which the value of the bond will fall for a 1% per annum increase in market interest rate. So the market price of a 17-year bond with a duration of 7 would fall about 7% if the market interest rate increased by 1% per annum. Convexity is a measure of the curvature of price changes. It is needed because the price is not a linear function of the discount rate, but rather a convex function of the discount rate. Specifically, duration can be formulated as the first derivative of the price with respect to the interest rate, and convexity as the second derivative. Continuing the above example, for a more accurate estimate of sensitivity, the convexity score would be multiplied by the square of the change in interest rate, and the result added to the value derived by the above linear formula. Accounting treatment: in accounting for liabilities, any bond discount or premium must be amortized over the life of the bond. A number of methods may be used for this depending on applicable accounting rules. One possibility is that amortization amount in each period is calculated from the following formula: equals amortization amount in period number n+1. Bond discount or bond premium equals bond discount or bond premium equals, see also, bond duration, bond convexity, yield to maturity, coupon yield, current yield, clean price, dirty price, bond option, option adjusted spread, selected bibliography, Guillermo L. Dumrauf. Bonds, a step-by-step analysis with Excel, Chapter 1, Pricing and Return. Kindle edition A. Frank Verbozzi. Valuation of Fixed Income Securities and Derivatives. John Wiley. ISBN A978-1-883249-25-0. Frank J. Verbozzi. Fixed Income Mathematics, Analytical and Statistical Techniques. John Wiley. ISBN A978-0071460736. R. Stafford Johnson. Bond Evaluation, Selection, and Management. John Wiley. ISBN A0470478357. R. Donald J. Smith. Bond Math, The Theory Behind the Formulas. John Wiley. ISBN A15766003067. Bruce Tuckman. Fixed Income Securities, Tools for Today's Markets. John Wiley. ISBN A0470891696. Pietro Veronesi. Fixed Income Securities, Valuation, Risk, and Risk Management. John Wiley. ISBN A978-0470109106. References and external links. References: A. B. Verbozzi, 1998, http, www.investopedia, amortizable bond premium ASP, http, www.investopedia, advanced bond 2 ASP, John C. Cox, Jonathan E. Ingersoll and Stephen A. Ross. A Theory of the Term Structure of Interest Rates, Econometrica 53-2, Discussion, Bond Valuation, Professor Campbell A. Harvey, Duke University, A Primer on the Time Value of Money, Professor Aswath Damodaran, Stern School of Business, Basic Bond Valuation, Professor Alan Apple-Mitre, Wake Forest University, Bond Price Volatility Investment Analyst Society of South Africa, Duration and Convexity Investment Analyst Society of South Africa, Calculators, General Purpose Bond Calculator, Securities Industry and Financial Markets Association, Bond Price Excel Spreadsheet, Professor Alan Apple-Mitre, Wake Forest University, Bond Pricing and Duration Excel Spreadsheet, Professor Kurt Hess, Waikato Management School, University of Waikato.